This chart tracks Horizon Reclaim's net profit over the 3 years leading up to their IPO. Between FY24 and FY26, their profit jumped from 0.71 crore to 10.50 crore. That is a 14-fold increase in a very tight window. The company generates that profit by recycling discarded industrial scrap, like old tires and tubes, into usable raw materials. Operating out of a facility in Uttarakhand, they have an installed capacity of 14,100 metric tons per year. They sell these reclaimed rubber products B2B, supplying manufacturers in the automotive and footwear industries. Now, they are looking to raise 54.27 crore in an IPO. An eye-catching 53.63% return on equity serves as the primary data point for those evaluating the offer. On paper, the company looks like a highly profitable green tech growth engine, but the specific venue where they are choosing to list changes the risk profile for anyone buying in. Horizon Reclaim is not offering shares on the standard retail market. They are listing strictly on the BSE SME exchange. This table compares standard mainboard IPOs to the rigid rules of this SME listing. To buy into Horizon Reclaim, you are forced to purchase in strict lots of 1,200 shares. That requires a minimum capital commitment well over 1 lakh rupees, pushing up toward 2.35 lakh depending on your allocation. Most retail investors are used to testing the waters with low-friction $150 minimums. The SME market eliminates that option entirely, and that lot size remains fixed even after the stock begins trading. If the share price drops, you cannot sell off a portion of your position to manage risk. You either hold the 1,200 shares or you sell the entire block at once. Your profitability depends on the demand for recycled rubber, but your exit strategy depends entirely on your portfolio's ability to withstand the highly illiquid mechanics of an SME exchange. To understand the actual business health, we need to look closer at the financial anomaly between FY24 and FY26. This chart maps revenue against net profit. Revenue grew steadily, climbing from 20 to 49 crore, but the profit line spikes exponentially. This results from aggressive margin expansion right before their IPO, culminating in a 21% PAT margin. There are operational strengths supporting their baseline revenue. They maintain an impressive 50% repeat customer rate and have built a geographically diversified client base across multiple Indian states. However, extreme margin expansion right before an IPO is often a sign of window dressing. Those attractive valuation metrics may be difficult for the company to sustain once they are operating as a publicly listed entity. The IPO is a completely fresh issue of shares, bringing in 54.27 crore directly to the company. This flowchart tracks how management uses the new capital. Nearly half bypasses the factory floor entirely. They've allocated 26.70 crore to repay outstanding past borrowing. By contrast, only 9.43 crore goes to capital expenditure for new plant and machinery. The company carries a debt-to-equity ratio of 1.44. In this sector, scaling production requires securing long-term quality certifications from major automotive and footwear brands, a process that naturally limits how fast capital can be converted into growth. The trade-off is clear. If you buy into this IPO, your capital is primarily being used to clean up the company's past liabilities, not to fund aggressive future expansion. We have to step back from the internal financials and look at the external, structural risks of the BSE SME market. Liquidity risk is the defining feature of these exchanges. Because you are forced to trade in fixed lots, the actual pool of available buyers is incredibly small. If the broader market turns negative and the stock hits a lower circuit limit, buying volume can completely evaporate. When that happens, you cannot incrementally cut your losses. You are locked into your 1,200 shares until you can find a buyer willing to take on the exact same capital burden. In the SME space, even a company with solid fundamentals and steady revenue can trap a retail investor if market momentum suddenly shifts against them. Horizon Reclaim is a certified manufacturer carrying a heavy debt load and the severe liquidity baggage of an SME listing. This scorecard maps 3 distinct investor profiles to specific, actionable outcomes for this IPO. For the retail beginner, this is an absolute avoid. The massive capital lockup and the severe liquidity trap of SME lot sizes are too dangerous for a standard retail portfolio. For the ESG or value fundamentalist, this is a wait. You need to see 1 or 2 post-listing earnings reports to prove that the recent 14-time profit jump is a sustainable reality and not just a temporary pre-IPO spike. For the yield-hunting high-net-worth individual, this is a calculated play. Your decision should depend entirely on subscription momentum and gray market premium. Because the company is using the IPO proceeds to aggressively pay down debt, their interest expenses will drop. That deleveraging math is strong enough to support a short-term listing pop, provided you use strict capital limits. The allure of a high-growth, green tech manufacturing narrative is strong, but you must never let a good story blind you to the brutal, unforgiving mechanics of SME exchange trading.